Good morning from our global headquarters in New York. I'm Manus Crenny. You're welcome to Bloomberg Brief. Let's set your agenda. Cementing the Fed cut, markets count down to the CPI as producer prices deliver another brick in the disinflation wall. UBS produces a punchy beat on profits and progress with integration. Emotti doubles down on $1 billion buyback this year. And make up and break up. Mars inches closer to a deal to buy Kellanova as the DOJ mulls breaking up Google following an antitrust win. A very good morning to you. You had the PPI come in yesterday. The groundwork that plays into PCE was good. It was tame. It built the narrative that you're getting closer to a 50 basis point cut in September. S&P 500 had its best four-day run higher of 2024. What happened last Monday? You know, where is your memory? We are flea-like in our memory. Still, the Russell lags the rest of the market. 40% chance of a 50 basis point cut. And Bank of America's clients are net buyers for the first time in over a month. Google this morning, Alphabet and Google down Alphabet down 1.35%. Interesting, the stock closed up yesterday. It's a little bit lower this morning as Europe digests the various remedies that may be delivered by the DOJ mulling to seek a breakup of Google. If that happens, wow. Bond market, I had a quick look at this. We're down 8 basis points so far this week. And again, the trajectory is for the PPI, the services dipped. That plays into the narrative. The CPI should be well behaved. Recessionometer from Goldman's is up a tick higher at 41%. JP Morgan raising the probability as well, although Bostic wants a little bit more time. I go to iron ore. There is a salary warning from one of the biggest steel producers out there. Buckle up. You're going to have downturns in China and this market, like 2008 and 2015. A severe winter is coming. Maybe that's a more prescient warning to the rest of the narrative for growth around the world. My guest today is Principal Seema Shah. She weighs in on this very topic of recession and the odds. And this is what she says. Our view remains that household and corporate balance sheets, strength implies recession is unlikely, but the risks are building. If economic data continue to deteriorate, the Fed stands in a good position to respond aggressively. Let's contextualize what an aggressive response mechanism is. Seema joins me now. Seema, if I look at the PPI, it laid the table for an optimistic call on the CPI today. You talk about the potential or the ability to deliver an aggressive response. My question to you would be simple. An awful lot has got to go quite wrong to deliver an aggressive response. Isn't that the case?
Hi, Manus. Yes, I would agree. And actually, our expectation is that you're not going to see the need for the Fed to react aggressively. But I think what is reassuring, or it should be reassuring to markets and anyone that is concerned about recession, is that the Fed has a lot of room to cut rates. You know, we're not back to where it was 5-10 years ago, where they were almost at the zero bound and we only had the option of QE. There are significant rate cuts that they can deliver if we need them. I do think that an intra-meeting cut, would require financial systemic problems looming, which really we can't see much sign of. So the aggressive response would be a 50 basis point cut in September, another one in November. Certainly that is not our current scenario, but I think it's reassuring to know that they do have space to cut aggressively if they need to.
And I think it's interesting, you look at, again, more idiosyncratic information. The National Federation of Independent Small Businesses, optimism there, the highest since February 2022. Seema, I like the way you put this. We're either facing an economic riptide or merely a ripple. Are you any further along in understanding the reverberations in the pool of angst?
Well, so we're in a really difficult time at the moment, I think, for analysts and everyone alike. And if we look at, of course, the two data prints from before the market sell-off, so the ISM manufacturing and the jobs report, they were particularly weak. And then last week, up to this point, we've actually had fairly reassuring data, which should have reduced some of the recession concerns. But I think there is a bit of an aftertaste from that market sell-off, where you have seen people say, well, look, there is maybe a deterioration in market sentiment. And if you have a deterioration in market sentiment, which leads to declining consumer sentiment, that certainly does raise the recession risk. The thing that we're really watching out for is, of course, the job market. If you see layoffs starting to build, well, typically that can become a self-reinforcing loop. And that very quickly does increase the recession risk. We don't see any signs of that right now, but watching out for, of course, the jobs report, but jobless claims surveys, all of the information is really important to build up that picture.
Yourself and Callum Pickering can go to lunch then, because it's sort of the buyers of the Psalm rule and that narrative around that. Here's the thing, though, Seema. It is about whether real rates are repressive. Real rates are tight. That's the view coming from Paul Donovan over at UBS this morning. He said that's the biggest mistake of all. Real rates will have a real long variable lag, and that is our bigger risk in this back quarter in Q1 25.
Well, I think the real rates argument has been really important throughout. And actually, just 2 months ago, when people were questioning whether or not the Fed would even cut rates this year, the argument was that if inflation is falling, then real rates are increasing, and therefore monetary policy is becoming more and more restricted. So the Fed has to act. I do think we have to put some weight on the real rate argument. In terms of the lags, we know it's somewhere between 6 to 18 months, potentially longer. So there is some urgency, in which I do think that if you are starting to see those economic concerns build up, it's really about front loading those rate cuts, which is why, if they do a 50 basis point cut in September, it doesn't necessarily mean that they would extend that pattern throughout 2025. Yeah. It's more about bringing together all the force at the beginning so that they can ward off any further recession risk from building.
And that is about, I suppose, prevention rather than cure. You talk about markets, and the equity market specifically, Seema, vulnerable to but grinding higher. There's a real reluctance to test the lower bound. There seems to be this ever-ending desire to buy the dip, despite what was thrown at us last week. What are we up overnight? S&P 500 up again. Yesterday we were up 1.6%. NASDAQ was up 2.4%. There is a real resistance to believe in the downside.
I think that's true, but I also think that's because there's so much ambiguity about the economic outlook. If you look at household balance sheets, if you look at corporate balance sheets, they're still very, very sturdy. So for economic weakness to then turn into recession is somewhat, I won't say far-fetched, but I think that knowing that the Fed can step in size probably does actually reduce that recession risk probability. And certainly for us, we do think that the market is going to be very volatile as the market weighs up every single bit of economic data, which comes out not just for the next month, but actually also for the next couple of months, that you do continue to test up and down. But I think overall, assuming that we do avoid recession, then actually earnings growth should continue, and that should lay a path for equity markets to continue to rise, albeit, of course, nothing like the gains that we've seen in the first half of this year.
Maybe I'm just a little bit too late to buy that dip. Seema, thank you very much. Good to have you with me this morning. Let's see what the CPI numbers are a little bit later today. That will ultimately define the risk narrative for the rest of the week. Seema Shah of Principal Asset Management. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. Japan is set for a new leader as the Prime Minister Kishida decides not to run for a second term. The leader of the long-ruling Liberal Democrat Party said he would devote himself to supporting the new leader, who is likely to win the leadership race expected in late September. Elliott escalates its push for sweeping changes at Southwest Airlines. The activist investor nominates 10 candidates, including 3 former airline chief executives, to Southwest's board. Traders are bringing forward the bets on the pace of the Bank of England's interest rate cuts. That's after the UK inflation numbers increased less than the economists had estimated, and the Bank of England expected, with the CPI rising 2.2% in July rather than 2.3%. In actual fact, we've had some pretty encouraging news flow around currencies this morning. So the CPI in the UK comes in that little bit lower. 2 Bank of England rate cuts are now priced in. The pound is down by 1/8%, so 2 cuts for 2024. Services are the lowest in 2 years in the UK. For the Kiwi, and this is important, the central bank governor there, Orr, says that 50 basis point cut was considered, and you can see the Kiwi against the dollar there tanking by over 1%. And the yen investors, be wary. 147.10, where the dollar's up 1/8%. But retail investors have locked and loaded their bullish yen wagers to nearly a record level, up another 22%. So retail like the long position in yen. Currencies are definitely ground zero for volatility. Coming up, Alphabet getting ahead in the pre-market trade as the DOJ is said to be considering a rare bid to break up Google. We bring you the scoop right here on Bloomberg. Hey, it's Bloomberg Brief. I'm Malek in New York. Shares of Alphabet are falling as the U.S. Justice Department is said to be considering a rare bid to break up Google. That's after a court ruling found the tech giant monopolized the online search market. Now, if the ruling is pushed through, it would be Washington's first push to dismantle a company for illegal monopolization since the unsuccessful efforts to break up Microsoft. That was 2 decades ago. Tom McKenzie is tracking the tech stories as ever. Tom, look, this is about a tectonic shift. The ground is going to shift under Alphabet. It's now just a question of the scale of the shift and the reparations and the impact on the business. So talk me through the level of threat from the DOJ, because just a week ago you and I were saying, oh, we've had the ruling, but we didn't see any sign of a breakup threat in the first read.
Yeah, Manus, look, you sum it up perfectly there. We knew leading up to this Bloomberg scoop that this could be an option for the DOJ. Now we're reporting, our team on the ground, of course, with this scoop, that it is one of the options. They haven't decided which option, but we know this is in the mix. They are prepared to press the button on a breakup of Google. What that could look like then is the divestment of Chrome, the web browser, and the divestment of the operating system Android, as well as their advertising platform, Google Ads. This is a potential scenario that the DOJ are now considering. On the back of this monumental ruling, don't forget this historic ruling that we talked about last week, that came through from the judge who said, yes, Google is a monopoly. And part of the reason it's a monopoly is because it's been paying Apple and Samsung these exclusive contracts, these exclusive deals to host the web browsers on those smartphones to the tune of about $26 billion, by the way, for those smartphone makers. So this is one of the consequences. There are lesser severe options the DOJ could go for. Part of this is interesting as well because it's also forward-looking. It's also considering Google's role, Android's role, and Google's role in terms of AI. And one of the solutions could be to get them to share more data with their competitors, which could reduce the risk of them being a monopoly when it comes to AI. But certainly ending these exclusive contracts seems very likely in terms of one option for the DOJ. But they are also considering pressing that button on a breakup.
Well, let's just stay with the tech theme because Norges Bank, they reported their results yesterday. This is one of the world's largest sovereign wealth funds. 8.6% return. Tech was the alpha. But I'm just wondering, the part of this story is that they're trimming some of their big positions in tech in Meta and ASML and also in Nova. Is that because they've had an exceptional run? Have they told us any more details on it yet?
We don't know the details yet. We're going to be speaking to the CEO in a little over 1 hour's time. So we'll see what Tangen has to say about the rationale for that and whether this is good timing in terms of taking profit on some of these big tech names. As you say, stateside, Meta was one of the standout names in terms of trimming their holdings in that business. Novo Nordisk here in Europe, of course, consequential around the obesity drug business. They've trimmed their holdings there. And then ASML, in terms of the maker of lithography machines, also trimming the holdings there. Interestingly, Manus, they've increased their holdings in terms of some of the energy companies like BP and Exxon.
Yeah, I mean, that was one of the very interesting pieces. Of course, we're going to have an opportunity to speak to the man himself a little bit later on some of the motivation. Tom, great work on the story. And, of course, big shout out to the print team on the Alphabet exclusive, breaking that news. Tom McKenzie in London. A different story. This time, the confectionery sector. Mars is expected to announce a deal to close a $30 billion worth of snack maker Calanova later today. The Wall Street Journal is reporting that the privately held company is expected to pay $83.50, all in cash. Let's unwrap the details and the motivation. Dasha Afanasieva joins me now. Dasha, I mean, it's a really surreal time to see somebody like Mars pay this amount of money in the consumer space for snacks that we're all supposed to be turning away from and injecting ourselves with Ozempic.
Absolutely. So for Mars, the upside is that they're diversifying away from cocoa-based snacks, which is a big chunk of its portfolio. They also have pet food and they have chewing gum. And they're also spreading, they've got geographic spread by acquiring these non-chocolate snacks like Cheez-Its and Pop-Tarts and Pringles. But as you said, paying a 30+% premium on a company that is at the heart of, consumers turning away from it, certainly in which is still, I think, about 50% of its revenue, is kind of counterintuitive. I guess Mars has decided that that's the downside from that has already been priced in. And there is an argument to say that an asset like that, with the increased scrutiny on junk food makers because of their sugar and salt content, you could argue that an asset like that is better in private hands. But I'm not sure if a public company would have gotten away with such a premium at such an uncertain time.
Well, the two of them together, Mars and Kalanova, it's going to be, what, 12% of the snacking industry, the candy industry. That's according to Nielsen. Dasha, thank you very much. Let's keep an eye on that space. Bloomberg's Dasha Afanasieva on the deal flow. Coming up, shares of UBS rally after the lender delivers a handsome beat.
We set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years, and then from there onwards we will look at ways to improve further.
That's coming up next. Context matters every day on Bloomberg.
Asia continues to be a pretty good secular driver of growth for our business. The US, I'm glad we are making good progress with some initiatives to make the IB and wealth management working closer together. This has helped our transaction activities in wealth management. We set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years.
The UBS CEO, Sergio Motti, there on the efforts to return capital to shareholders, getting a boost after a profit beat in the second quarter. Francine Lacroix is on the ground in Zurich for us. Francine, good to see you this morning. I mean, he's delivered robustly everywhere, double the estimate on profits. And I think doubling down on this buyback is one of the big sort of alphas in these numbers this morning.
Yeah, absolutely. First of all, Manus, you're missed in Zurich every time I cover UBS. I kind of think, there's a cranny standard that I need to make sure I uphold at every time. But look, Sergio Motti was in good form today. He beat on many things when he gave us a timeline also of acquiring and putting together Credit Suisse. He's sticking to that. And when you speak to a lot of analysts and some of the bankers, of course, that cover UBS, they say, look, whatever they can do internally, they're on top of it. They're streamlining, there's job losses, they're cost cutting, they're able also to attract inflows in wealth. And a lot of the focus, of course, will be on wealth management with Iqbal Khan going to the US, to Asia, and with a new person in charge of the US where they want to push through. So it seemed like at the moment they're firing on all cylinders, but they're also worried and preparing for possible capital requirements.
I watched the conversation and I saw where you kicked into gear on the regulatory front. And this is where he will do a battle royal with the regulators in terms of the extra capital that the regulators and the government want in Switzerland versus the shareholders. And he's certainly squaring up to them publicly, isn't he?
Yeah, he is. You're right. I love the fact that you use the word battle royale because it is a little bit like that. But as soon as we heard from policymakers of what they wanted to do and actually force banks, i.e. UBS here in Switzerland, to hold extra capital, he went all guns blazing saying, look, this will hurt this and it will impede what UBS can do in the future. And now he actually took a bit of a turn and says, look, it's just too soon to speculate. So what he did tell us, there was nothing on capital requirements or on what the Swiss regulators want them to do in the earnings report. When I asked him a couple of times in the interview afterwards, he said it's too soon to speculate. He does not expect it to change any dividend or shareholder buyback plans. But he did give us a little bit of a timeline that he's expecting to know more by the end of the year. And that's when we'll have probably a broad figure and we'll see whether it changes actually the business plan for UBS going forward.
Look, briefly, this is the CEO that you and I know very well. He comes from a markets background. What was his take on the past 10 days? Briefly.
Yeah, he was very good on that. And he said, first of all, that he does not expect the Fed to cut as much as the markets expect it to. And he says, given the volatility, it'll just show who's best. We know, Manus, that he doesn't shy away from race or to how, to showing the world what UBS can prove and achieve. And I think he says this is the right time to be close to customers. It showed us that there's going to be even more volatility. He mentioned geopolitics. He mentioned this U.S. election, and they're ready for the fight.
They're ready for the fight. A fragility in markets. That's why you depend on your wealth manager. Francine, great work. Good to see you in Zurich there. I miss it. Regards to everybody in the office. Francine Lacroix on the ground in Zurich, tracking the UBS story. A snapshot of the bond markets. Flat on 10s, 384. We're counting down to CPI. Will it be plus 0.2%? Better news flow in the UK on inflation. Yields dropped 2 basis points. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manus Crenny. Let's set your agenda. Cementing the Fed cut. Markets count down to CPI as producer prices deliver another brick in the disinflation wall. UBS produces a punchy beat on profits and progress with integration. And Motti doubles down on $1 billion buyback for 2024. And makeup and breakup. Mars inches closer to a deal to buy Kellanova as the DOJ mulls breaking up Google following an antitrust win. State of play of markets as we're counting down to CPI. That will define the risk narrative ahead of the retail sales tomorrow. S&P 500 still inching into the green there just about. 4-day rally, the best 4-day rally that we've had on the S&P 500 this year. Bank of America's clients in the survey are net buyers for the first time in over a month. Flat is where we are on 10-year government. By the way, keep an eye on Alphabet at the bottom. I'm surprised. Yesterday it closed up on the back of the Bloomberg exclusive that the DOJ is mulling a breakup of Google. The stock traded up into the close yesterday. We're now down 1%. That is Europe. What will the street do as they come in? Iron ore is also under a bit of pressure this morning. You've got one of the biggest producers of steel warning, buckle up. The downturns are coming, similar to 2008 and 2015. There's a severe winter on the way in China. That will have a reverberation across the world. Maybe that's what's causing moments of pause in the house of JP Morgan and Goldman Sachs on their recessionometer, incrementally going higher to 41% at Goldman and 31% at JP Morgan. We're less than 3 hours away from that. Sorry, less than 3 hours. I got the time right. It's an early time, 5:30 in the morning, 3 hours to go until the CPI hits the tape. Mike McKee is with me around the desk. We got him up early. We brought him in early. Now, the last month was a surprise. What should we really focus on in this set of CPI today, Mike?
We're going to focus on progress. Is there incremental progress, or does something go the other way that would cause Wall Street to start to worry that maybe the Fed is behind the curve, either letting inflation go out of control or inflation's coming down so fast that it signals any kind of weakness in the economy? But as you can see, we are looking for a slight rise in both the headline and the core on a month-over-month basis because we had a big surprise on the downside last time. Doesn't make a whole lot of difference year over year because essentially we're into a base effect situation where inflation was higher last year. So the move isn't going to be as big. But as long as it doesn't suggest we're going the wrong way, then Wall Street should be happy.
And the PPI yesterday, the component parts of that PPI yesterday that play into the PCE, I know that we've talked about this over the past 24 hours, but again, that builds on the narrative on why the bond market rallied, why the market is incrementally moving towards a bigger rate cut in September.
Well, we're looking at things that had not moved a lot, like housing. And while it's not as big a deal in PPI and CPI, it is the whole ballgame. It's like 30%. And we're finally seeing some declines in housing prices in the way they measure it, which is a kind of a controversial method, shall we say. But as you can see, housing prices are starting to go down. And if that continues, then that's going to put some real downward pressure on the overall CPI and make the numbers look better.
we're also going to get retail sales tomorrow, and that, you know, we've had various sort of canaries in the consumer coal mine becoming more judicious at Home Depot, Heineken finding it tougher here in the American markets, etc. The thinking on retail sales is what? Remain reasonably robust?
I don't think people would use the word robust, but remain still going up, put it that way. The feeling is that maybe people have started to cut back, and that's a concern. So it will be very interesting tomorrow to see retail sales. Now, retail sales are primarily goods sold. So we'll see if there is a cutback by consumers. But following the jobs report and some of the other disappointing numbers that we've had, there's a narrative growing that maybe the economy has slowed too much, or we're getting into a stagflation situation. So if we had a bad CPI report today and a bad number tomorrow in retail sales, then you'd start to hear that word again, stagflation. It too early to say that's happening, but it would start going around Wall Street. So we got to keep an eye on both of those things and remember that Jay Powell said they're going to look at the totality of the data when it comes to their September meeting.
It's interesting, Apollo's Torsten Slok, his morning note this morning talks about credit card utilization still significantly below 2019 levels. This is interesting, especially for the baby boomers. I'm not quite in the baby boomer camp just yet. Let's just have a quick reflection. This is what Paul Donovan has put out this morning. He's talking about the U.S. Consumer price inflation forcing economists to become used car salespeople and real estate fantasists. Part of the disinflationary trend comes from used cars, which most U.S. households will not buy this year, and fictional owners' equivalent rent, which no one pays. I mean, this is rather scathing of Paul, but it's sort of classic Paul. And he says the bottom line is you've got tight real rates. That's the bigger error rather than not cutting sooner.
Well, the question for the Fed is not just what does the CPI tell us, but how they react to it and how they react to the components. Now, obviously, Paul has a point about owner's equivalent rent in particular. However, owner's equivalent rent was a reason that inflation went up. So while it may be mismeasured or measured badly, it works on both sides. So the Fed has to take that into account. And also, they look at the PCE inflation numbers, which give a much smaller weight to housing than CPI. But it is something to keep an eye on. But there are definitely two camps on Wall Street, one saying Fed needs to do more and or at least stay higher for longer, and the other saying the Fed is behind the curve. And there's no way to know really until we get past the curve. But at this point, the Fed seems relatively confident that it is not.
Indeed. And Bostic is very reluctant, to pull the trigger. Yeah.
Bostic and Mickey Bowman in this past week saying, we're not ready yet.
No, they're not there yet. They are reluctant. Mike, thank you very much. Mike McKee. It is 3 hours away, and Mike will break that news with the surveillance team live for you. My guest now is Mark Malek, CIO of Siebert. Mark, good to have you with us. Look, so much sentiment is hanging on every piece of economic data. The PPI laid the table. The CPI is today. The Fed has the wind at their back, but it's still very, very hard to call this market at the moment. For you, what's important today?
Well, clearly, we're going to be focusing on the components of the CPI, as Mike just pointed out. We're going to be looking at services, which has been the problem. We're going to zero in on that controversial rents number that has been bubbling down. Although very slowly, we'd like to see it continue to come down. That could certainly be a rainmaker in the wrong direction if it comes in slightly higher. We're going to be focusing on that, but looking forward to the markets, we too are looking at those sort of recession indicators as well to really set the tone for the market going forward.
And yet, if I look at some of the information that I have in the past 24 hours, the small business survey, optimism is up there. Yes, they're being squeezed and they've got issues. And some people are saying, look at that data rather than perhaps anachronistic data that's not fit for purpose. Small businesses are the lifeblood of this economy in many ways. And if they're still optimistic, we shouldn't be so quick to hurl the recession brick.
Sure, agree 100%. They're going to be watching they're going to be watching interest rates. Small businesses are relatively sensitive to interest rates. But at Siebert, what we like to look at now are these earlier indicators, as you suggested. We're looking at consumer confidence types of numbers, which might be more leading indicators of consumption. Consumption, as you know, makes up 66% of GDP. So we're looking at things like consumer confidence. We're going to be watching this Friday's UMich number. We have consumer confidence coming out next week or in a couple weeks. We're going to be watching that as well.
Okay.
These are sort of more leading indicators for how comfortable consumers are.
Tell me then, the S&P's had its best four-day rally of 2024. Is that misguided confidence?
We're kind of positive on the market. I mean, this recent pullback, you know, some of the growth sectors that everybody loves and we still like as well, you know, those have become, let's call it, more valuable with this recent pullback. They still haven't come back all the way. The growth story for some of these companies hasn't changed. They're just a little bit more on sale at this point. So it sort of makes sense for people to be nibbling back in at the market. Assuming that these upcoming numbers, today's number, the retail sales number coming out, and assuming these numbers support that thesis, we think that there's a little bit of room here still.
Look, we have one headline today, Mars bidding for Kellanova, the DOJ making a play, a Bloomberg scoop, to break up Alphabet. On the M&A front, it's a very interesting move by Mars at this moment in time. There's a couple of things that people have said to me will create floors in this market. One of it is M&A and the other is buybacks. How important are those facets to you?
Well, they are certainly important, and they bring to the front of the discussion the presidential election. We're all watching that very, very closely. We don't have a lot of sort of, let's say, call it policy out of the Democratic side yet, although, you know, earlier speculation would assume that, you know, a Democratic win would certainly, you know, put some clouds over the M&A market versus a Republican win. So I think a lot of us are looking very closely at that in the M&A market, how that might impact what a future DOJ might look like, you know, with Alphabet and this another proposed merger that we just discussed before. So that's going to become the front of the discussion when we're talking certainly about mergers and the DOJ and the FTC and all that stuff.
Tell me this, we haven't had a sit-down interview yet with Kamala Harris. What do you want to hear from her? What do you think the market wants to hear from the ticket?
Well, I think we'd like to hear a little bit, you know, more moderation, some more business-friendly talk, some actual solid policies. You know, the only thing we really have at this point is sort of rhetoric, which seems to be mimicking the Republicans' platform. So I think the market certainly would like to hear her take on you know, her approach toward business, what her thoughts are on corporate taxes and things like that. Those will have direct effects on the market.
Okay, well, the devil is in the detail, as they say, isn't it, Mark? Let's see what comes out of those initial sit-downs, if there are multiples or just one. That is Siebert's Mark Malek on the markets. Coming up, UBS getting a boost after delivering better than expected profits. More on the story. The stock is bid this morning, and Motti doubles down on his buyback. This is Bloomberg.
Asia continues to be a pretty good secular driver of growth for our business. The US, I'm glad we are making good progress with some initiatives to make the IB and wealth management working closer together. This has helped our transaction activities in wealth management. We set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years.
UBS, the stock is rising this morning after beating analysts' profit estimates, bolstering the CEO, Sergio Motti's plans to return $1 billion through 2024 in buybacks. Alessandro Speziali joins me now from Zurich. Alessandro, thanks for taking the time. If we look at the drivers of the beat in this quarter. Obviously, wealth management is incredibly important. It's about the inflows and the activity of clients, isn't it?
Yes, yes, and it was a solid quarter. It was $27 billion of new net assets, which was on par with what UBS did in the previous quarter. So it shows that there is a solid trend of new assets coming in. And of course, then the surprise maybe here was also the good results of investment banking. Did almost $500 million of profits there because of higher transaction activity, especially from institutional investors. That's also a good sign going forward, especially given that UBS has some regulatory headwinds, especially here in Switzerland. Regulators want to impose more charges for UBS's foreign units, wants UBS to retain more capital against those units. We'll know exactly how much in the first half of next year, but Ermotti said that there is probably no risk to the capital distribution plans of his bank.
And herein lies the point. We were chatting to Francine a little bit earlier. I just wonder how this landscape looks. It is a battle. It's a battle of wills and regulation, really, between Ermotti and Kelleher in terms of the capital that's required for now the biggest bank in Switzerland, one of the biggest in the world, systemically important banks in the world, versus the shareholders. And the shareholders, if we're to close the price-to-book valuation to the US banks here on the street, it is going to be about the amount of capital that they hold and the distribution that they make.
Absolutely, absolutely. And Ermotti and UBS have made it very clear that they want to compete against their Wall Street peers. Those are really the banks that they see themselves as competing around all over the world. It's been quite surprising here in Switzerland because UBS went from being the savior that came in and swooped in and rescued Credit Suisse and stopped what could have been a broader banking crisis, and then there has been quite heated words both from the government and from UBS on these capital requirements. UBS and Ermotti, Kelleher have both been pretty vocal that this would be a good idea, that UBS is not a problem, but has been and will continue to be part of the solution. We'll see how it plays out. The rhetoric was a bit toned down today, so UBS has made its point clear, and we'll see how the regulatory landscape will shape up in the next few months.
Having spent time with Ermotti when he went through the first radical shake-up of UBS 10 years ago, and over that period of time we met several times, he's a CEO that knows how to reduce and cut the non-core legacy assets aggressively and quickly. And I think that's part of this story. Non-core risk-weighted assets down by 42% in the second quarter. He's moving with haste.
Yes, yes. The implementation of the Credit Suisse mergers is progressing apace. UBS has shown that it's keeping its targets in implementing. I think it was 8 billion reducing assets in the second quarter. Cost reduction targets have been increased to 13 billion overall, and it's on track there too. It's on track of getting back to the profitability levels that it had before the merger. So yes, there's still a lot of discipline on the merger, and at the same time, I look at what's going to bring profits for UBS in the future. There has been recently a restructuring of the wealth management around now two co-global heads, Rob Karofsky in the US and Iqbal Khan in Asia, and of course that's also probably shaping up the battle to succeed Ermotti in a few years' time.
Alessandro, thank you very much for being with us this morning. Alessandro Speciale in Zurich. Let's pivot to technology space. Different story. Alphabet, the stock this morning falling as Bloomberg delivers the scoop. We learned that the DOJ is mulling a rare bid to break up Google. Now, that's after a court ruling that found the tech giant monopolized the online search market. If the bid is pushed through, it would be Washington's first push to dismantle a company for illegal monopolization since the unsuccessful efforts to do that 2 decades ago to Microsoft. Tom, McKenzie is tracking this story. Tom, it's a Bloomberg scoop. How big is the threat? How real is the threat on the level of reparations of a breakup? Is breakup top of the agenda?
Breakup is being considered, and it would be the nuclear option for the DOJ. And a breakup would include, we would expect, and this is our reporting, the divestment of, for example, the Chrome browser, but arguably more importantly, Android OS, the operating system, used in about 2.5 billion smartphones and devices around the world, 2.5 billion, but also the Google Ads part of the business as well. That's what a divestment could look like. That is why pre-market you're seeing this drop of a little over 1%, as you say, for Alphabet on the back of this. They could look at less severe options, though, the DOJ, and amongst the mix there would include ending these exclusive contracts that Google has had with the likes of Apple and Samsung, essentially to pay them, to compel them to have their web browsers set as the default. And in that case, and that context, this was where Google was found to be this monopoly. It seems very likely those contracts will be ended. It also seems pretty likely that the DOJ will pressure Google to share more of its data. But it's looking ahead as well in terms of how Google positions, I should say, around AI and how it can use its data dominance, and concerns about the fact that it could be a monopoly in that space as well. So those are two of the lesser severe options. But top of the list in terms of the most severe, in terms of consequences, would be the divestment. And we know now that is part of the mix for the DOJ as they weigh up their next steps.
Well, they certainly have. I mean, these are tectonic shifts. It's just a question of the scale of the shift and how that settles. Let's have a quick chat on Norges Bank. They reported the results. I think the more interesting thing is about the divestments that they've done, or the trimming, I should say, in some of their allocations to Meta, ASML, along with Novo. So it's interesting on the tech side, isn't it?
Yeah, look, there's some nuance here on the tech side because they've trimmed those holdings, as you say, in Meta. But amongst their top three holdings, in fact, their top three holdings include Apple and Microsoft and Nvidia. Nvidia, of course, reporting at the end of this month. So they're still in on tech. They're still exposed to tech. Of course, this sovereign wealth fund invests in about 8,800 companies globally. They're essentially invested in most publicly listed companies. But the tech story is nuanced. And interestingly, we touched on this before, they've also increased their holdings. As they trimmed on Meta and Novo Nordisk and ASML, they've increased around the likes of BP and Shell, where they've become a little bit more activist on some of those oil companies.
Yeah, it's certainly an interesting pivot. Tom, thank you very much. Tom McKenzie there on the very latest with the tech stories. We're going to catch up with the Norges Bank Investment Management CEO, Nikolai Tangen. That is at 11:30 a.m. UK time. We can begin to understand some of the trimming in tech. Coming up, setting up your trading day ahead of the CPI. Fed Speak is on deck. Context matters every day from New York. Good morning.